ask, which are the ones that jump out at you? What do they have? Is there a common thread that just sticks out?
Make me laugh? No, that's having the introductory email. We do. And I haven't done the numbers for a bit. So we set up in June 2009. In December, I think, we received something like 2,500 business cards. We've met with probably about 550 of them. So we try to meet with lots of people because you know what, our time actually isn't that valuable. I don't VCs think they are, but it's not that valuable. What we're meant to be doing is looking at companies. So as much as possible, I try to make a decision based on the meeting and how it went. And to Rose's question about the 3 mistakes, that's not kind of critical, but if somebody walks in with a 56-page presentation and tells me their forecasts are conservative, they've got 25 term sheets, they're probably not going to stand out apart from for a story like this. Of the 1,500, which is still or 2,000, which is still a big number of people we didn't meet with, a lot of those just didn't fit our criteria. Because often people will just write and say, I see you're a venture capital firm, I've got a restaurant, could you fund it? And you go, no. The one, I think again, it's just, for me, the best bit is an introductory email. People often don't, I do, but people often don't open up all the attachments. So if it just says, this is what we're doing, you know, this is how much money we're raising, this is why, it kind of works for me. And then we can make a call about whether it's a sector we like or not. So there are some areas where either we don't have enough expertise, I don't think SaaS falls into that, but if we really don't, there's a medical hardware. I mean, I quite like e-health, but more on the software side. There's a hardware thing where I feel it's quite cool, but the reality is, I don't know whether it works. I mean, I really don't, so we shouldn't be investing.
There was also a debate this morning about the sort of length of time VCs expect to be in a deal. What's your kind of view? Or
in terms of how long once we've invested?
Yeah.
Expect. I have no particular expectations either on time, size of the exit, or who the buyer is, or how the exit is materialising as IPO. I want to invest in businesses where together we can create value, and somewhere we will get paid out for that. So I suppose the quick answer is we're a 10-year fund, which can be extended for another 3 years, but in total. So theoretically, from June in 13 years, we should have gone through all of our investments. It won't happen. I think we have a particular issue, which is this is a first-time fund, and even though we all have experience from different places, that makes it very difficult to raise money. And so we have a desire to prove that we do actually have a good model, and that probably requires earlier exits. But I would never push for an early exit just for that, nor would I expect to see companies in 3 years they have to have floated, or in 5 years. We don't put a timeline on it, to be honest. But we expect at some time to get a return. Just to follow up, the only thing I wonder about is that for us, and we're too early, I guess, to have got to this stage, there might be a reason, either from our point of view or the companies or indeed future investors, whereby we can start, if you like, monetizing our stake earlier than a full exit. Often future rounds and bigger VCs require to put more money to work. It might make sense to do a bit of a secondary there. It might make sense for us because the bigger a company gets, or the more mature a company gets, probably the less use we're going to be in terms of our network, and the less important we become in the shareholder arena. We do reserve mentally the same amount as we invest for follow-on, so we would like to participate in follow-on, but if the next round is a $20 million round, it ain't going to be us.
Okay, so my favourite question to VCs at the moment is, do you think Facebook is overvalued? So I used to be a stockbroker, so I can talk to you as if it was a public market. On conventional valuation methods, even going as far as EV to revenue or something, they're very high. Having said which, and slightly different to how I would have acted as an analyst, I sense huge demand from the fund management community, kind of quoted fund management community, for growth stocks. I think that there's an argument going on at the moment which I've been interested in about whether this is another bubble like 1999, 2000. I don't think it is, because actually the difference is that these businesses are genuinely revenue generating proper businesses. It's to go to the eyeballs question, or the user questions. There were some companies around in 1999, 2000 which were literally just, we've got lots of people, we're very valuable. That's not the case for Facebook. So this is not investment advice, because I know my FSA that says I'm not allowed to, but if Facebook, or when Facebook floats, I'm going to shut my eyes to the valuation and do what I never did as an analyst, momentum trade. And you know what, when Google floated, there was a huge argument about whether it was the right number, and in fact they scaled back to $100. And Google grew into its valuation, and the reason is that once you go into the public markets, people think high growth is 25%. And so nobody will put in their model anything more, and analysts are a bit of sheep, nobody will put in more than 25%. So when you suddenly get a company that's growing much faster than that, it grows into its multiples much quicker than you think. So then I don't know whether the right price is whatever the market tells it to do, but I will close my eyes. And it's not a great way to invest, and we don't, by the way, invest like SVCs, the shutting our eyes and just going for it. But in that case, I just see such a wall of money that wants to buy growth stocks that momentum trading's in.
Very good. One sort of more final question, and then we have to close this session.
Just like continuing on from that question.
Other stock recommendations.
Well,
So I'm a buyer of them.
Yeah, tweet what Rogan is.
Facebook was
Yeah.
proven it can make money.
Yes.
Twitter, it's a different story.
Yeah.
Would you, do you think Twitter will ever sell the amount of money that's been put into it, or more?
Will ever sell for the amount of money? I think it's worth $10 million, or whatever the current valuation of Twitter is. 15. It goes up every day. So, so if I had to buy one of the stocks, and obviously it depends on the price of them, I probably would buy Facebook rather than Twitter. But that's, I think, partly because the valuation differential, if what is read in the press or what's in the second market is right, which is about 6-7 times or something, I don't think reflects the risk profile. Twitter is only just beginning to try to monetize. I think, inevitably, and like with all startups, its ultimate monetization will probably be different to what it's doing at the moment. And I can see it monetizing very well in time. Facebook, if you asked me this question 5 years ago about Facebook, and I know it wouldn't be this valuation, probably you wouldn't have thought about, well, you might have done, but the game revenues that would have come along, etc. So I think that Facebook's just that much more mature as a business, and as a stock, I would prefer to own that one, because you're right, it's proved a lot more, and the 7 times differential is probably just a reflection of big numbers now getting silly, and people don't know how many billions to put on.
And in a way, it sort of reflects what we were talking about earlier about actually what Facebook's done is reduce the risk for investors, whereas Twitter hasn't quite got that far yet. Maybe in another 5 years' time, Twitter would have also reduced those risks.
Well, that's it. I'd say, I mean, it's stage of investing, but it's also relative, and we do this as well. It's relative investing, and with any, I'm not saying I've got a portfolio effect for my personal investments, but there is a kind of, you need to balance the risk returns.
That's great.
That's a very corporate answer.
Any other final questions before we let Rogan go back into the audience and invite our next speaker up? Go on, one more quick one.
One of the kind of big investors in Facebook who put a big, I think it was a second round, Russian DTI.
DST.
Now he's obviously in San Francisco, in the Valley. He's set up a fund to kind of invest in lots more companies. And
So his deal with Y Combinator.
Yeah. So he's kind of trying to essentially monopolise the kind of, the way startups are funded, and eventually spread the risk, and hopefully one will hit. But he took a risk in Facebook, and one of the questions in when the Facebook valuation was done was that I met him, and at the time obviously people were still looking at Facebook and they didn't really understand, and he didn't understand it, but he just generally said, I quite like it, and that was it.
Yeah.
So sometimes about valuations and all that, you go.
Well, but that's my point. I mean, that's why. I mean, I suppose my caveats about closing my eyes and momentum trading, it reflects that. It also reflects social media and tweeting, and my previous life as a broker, so my FSA consciousness that you could all tweet Rogan Angelini-Hurll recommends a buy on Facebook, which would be probably end me up in jail. I think that's right. I think that totally different strategies. He maybe didn't understand Facebook. I don't know at that time. He understood one thing, which was that large internet companies were beginning to prove themselves, and that they would be high growth. And I think what he was, because he didn't just do Facebook, of course, a lot of them, was to say, you know what, there is going to be huge demand for these companies, and therefore their valuation is going to go up. What he's doing now, in my view, is saying two things really. I've played that game, and there aren't that many in that space where I can do it again, or I'm already an investor in them, so it doesn't matter. Let's try to get get in early, and one way to do it would be to say Y Combinator is a great program. I trust that people who've gone onto the Y Combinator program, a higher proportion than normal will be good, so I'm just going to invest in them all. And you know what? To take away any doubt about valuation or try to pick favourites, I'm just going to do them all, because on the balance of probabilities, I don't know what his statistics are, but one or two of those will become the next Facebook.
Yeah.
But I suppose he's using in a way Y Combinator as his filter. So he hasn't done it. He hasn't just stood up and said the next 20 people who walk into my office with a business plan, I'm going to give a, because I think that would be stupid if you did that. The second bit.